We just crunched the numbers on 2.5 years of market data, and what we found could completely change the way you trade ODTE options. The results are shocking, and frankly, they explain why so many traders are getting wiped out. Stick with me out of video. You'll understand the single biggest risk factor that almost everyone is getting wrong. All right, let's dive right in. When you're trading ODTE options on the SPX, one of the most common tools people use to gauge risk is the VIX1D. It's supposed to give you the expected move for the day. So, if the VIX1D suggests the market will move 20 points, you might set your short strikes on an iron condor just outside that range, thinking you're safe. It seems logical, right? That's what we thought too. So, we decided to put this theory to the test. We took every single trading day since the VIX1D was created, that is about 2.5 years of data, and we plotted this expected move against the actual real-world intraday range of the SPX. We call this the true range, which is the difference between the day's high and low. We expected to see a 1-to-1 relationship. If the VIX1D predicted a 20-point move, we thought the actual range would be somewhere around 20 points. A perfect correlation would give us a regression line with a slope of 1, but that's not what we found. Not even close. When we fitted the regression line to our data, this doesn't want to say that again, because it's the most important finding of this entire analysis. The slope was nearly 2. What does this mean in plain English? It means the actual intraday range of the SPX is consistently, systematically, almost double what the VIX1D predicts. If the VIX1D implies a 20-point move, the market is actually, on average, carving out a 40-point range between its high and its low. If it implies 30 points, reality often delivers a 60-point range. This isn't a fluke. It's not a weird anomaly that happened on a few volatile days. This pattern is consistent across the entire dataset. We're looking at a structural, fundamental gap between two different types of volatility. The VIX1D measures what's called close-to-close implied volatility. It's trying to predict where the market will close relative to yesterday's close. But as ODTE traders, we don't live and die by the closing price. We live and die by the intraday swings, the high and the low of the day. And that intraday volatility, as our data clearly shows, is a completely different beast. So, let's talk about what this means for you, especially if you're a premium seller trading strategies like iron condors or short strangles on ODTE day. The vast majority of retail traders look at the expected move and place their short strikes just beyond that number. It feels sand everywhere. You calculate the 1 standard deviation move and sell your options there. But if our data shows the market is actually moving twice that distance intraday, where does that leave your safe strikes? It leaves them right in the danger zone. Your short strikes aren't just close to the action. They're often well inside the realistic trading range of the day. Let's break down the implications. First, the expected move, as derived from VIX1D, dramatically understates the real intraday risk. It's giving you a false sense of security. Second, if you're building an iron condor based on that flawed number, your wings are way too tight. You think you have a buffer, but that buffer is an illusion. Third, this means your risk management is based on a bad assumption. The unexpected moves that blow up your account aren't unexpected at all. They are, in fact, predictable underestimates of the day's true potential range. The core of the problem is this disconnect. VIX1D is measuring expectations for the closing price. But your margin risk, the risk of your short strikes getting breached comes from the intraday high-low volatility. This intraday volatility is much larger, much noisier, and heavily influenced by things like intraday gamma flows, which can cause explosive, accelerating moves. That's why premium sellers can blow up even on days when the VIX1D suggests volatility is low. You might start the day, see a small expected move, and feel confident. But then a midday reversal happens, the market swings hard, and suddenly your position is deep underwater. It's not bad luck, it's bad math. You were using the wrong tool for the job. So what's the big takeaway here? After analyzing the entire lifespan of the VIX1D, the message is crystal clear. Succeeding in ODTE, premium selling is not about predicting implied volatility. It's about surviving realized intraday volatility. The two are not the same. And if you rely on the VIX1D's expected move alone, you are consistently and dangerously underestimating your true risk by a factor of almost 2. Now, this might sound scary, but it's actually incredibly empowering. Because once you understand this relationship, once you accept and respect that the true range is roughly double the expected move, you can finally start pricing your trades for the reality of the market, not the theory. This knowledge gives you a massive edge. You can now make smarter, more realistic decisions. For example, you can build your strategies with wider, safer strike placements. Instead of placing your short strike at one expected move, maybe you should be looking at 1.5 or even 2. This also leads to smarter position sizing. Knowing the real potential range, you can adjust your size to ensure a bad day doesn't become a catastrophic one. It also helps you develop better no-trade filters. On days where even a doubled expected move looks too risky for your comfort, you can have the confidence to just sit on the sidelines. Ultimately, this understanding protects you from the very shocks that ruin most ODTE traders. You're no longer flying blind. This discovery is a game changer, but it's just the beginning. Knowing the problem is half the battle. The other half is building a solution. In our next video, we are going to take this critical insight that true range is about twice the expected move and turn it into a practical, step-by-step model for selecting your ODTE strikes. We will show you how to build a framework that reflects real intraday behavior, not just the flawed implied volatility metric. You won't want to miss it. Thanks so much for watching. If you found this analysis helpful and want to learn how to apply it to your own trading, make sure you subscribe and hit that notification bell so you don't miss the next video. 所以10